That leaves consumption. Consumption, the fourth component of planned aggregate expenditure, which we haven't said anything about yet. The way we treat consumption is going to be a little bit different from the way we treated the components of planned injections. With consumption, we're going to recognise that there are two distinct types of consumption expenditure undertaken by households. The key to this is the concept of disposable income. Disposable income refers to the income that households have left over once they've paid their taxes. Another term for this is after-tax income. There's going to be an important component of households' consumption spending which is directly influenced by disposable income. That is going to be endogenous, because we will be able to say something about that part of household consumption from within the model. And that's because the model is going to give us insight into the factors that determine aggregate income in the economy. So one important part of consumption is endogenous, because it is going to be directly affected by disposable income. Think about your own consumption behaviour. For most households, an important consideration in how much consumption can be undertaken is in fact their after-tax income. But we're also going to recognise that there could be a host of other factors that also influence households' consumption expenditure, factors unrelated to disposable income. We don't know what all of those factors are. They live outside of the model. Therefore, there's going to be a component of household consumption that is exogenous. So let's develop this, and I'm going to develop it using the concept of the consumption function. It's just a very simple algebraic representation of the idea that I explained in the previous slide, that household consumption has these two components. So on the left-hand side of this equation, we record the total flow of household consumption expenditure over a time period. The little d there reminds us that this is household expenditure on domestically produced goods and services. C bar on the right-hand side is that part of household consumption expenditure which has been determined by factors other than disposable income. And so there we collect the sum total of the exogenous consumption undertaken by households. This term, y minus t, y you recall is our notation for income, t is our notation for taxation, that term measures the disposable or after-tax income that households have available. That leaves this term here, lowercase c. Lowercase c turns out to play a very special role in this analysis, which we'll develop fully as we go forward. It's known as the marginal propensity to consume. I'll explain exactly what that means in a moment, but first I just want you to note that what we're actually talking about is a number. So lowercase c is actually representing a number, but there's a restriction on what values that number can take. It has to lie somewhere between 0 and 1. And a typical value might be 0.75. What does that actually mean? The marginal propensity to consume tells us that should a household receive an extra $1 of disposable income, then in this instance, 75 cents of that extra $1 will flow into increased consumption expenditure. So the marginal propensity to consume is a measure of the proportion of any increase in disposable income that is received that flows into increased consumption expenditure. So take a household that gets an extra dollar, and suppose its marginal propensity to consume is 0.75, so 75 cents of that extra dollar is used to finance some extra consumption. What happens to the other 25 cents? Well, that can be used either for saving, or it could be used to purchase some imports, or it could be used for some combination of both. So the $1 gets allocated across some extra consumption, some extra saving, some extra purchases of imports. What about taxes? How are we going to treat taxes? In the consumption function, we've just written capital T there, which just stands for the total amount of taxes paid by the household. We can actually say a little bit more about taxes, and this is the approach that's often undertaken in this analysis, and that is to divide taxes into two distinct components. One component is going to be an exogenous component. This represents any taxes that the household needs to pay that do not vary systematically with the household income. So there might be some fixed licence fees, for example, collected by the government for various purposes. And then we have an endogenous component of taxes, where this does systematically vary with the income earned by the household. Little t here, think of that as the tax rate. For example, it might be a number like 0.2. 20% of household income in this example is collected by the government in the form of taxes. So this is a very simple version of the tax system. The tax system, of course, is incredibly complicated in all countries, but most tax systems have elements of either exogenous taxes and certainly endogenous taxes. So whilst this is a very simple tax system, it's not completely removed from the tax systems that exist in reality. So if we take that little tax system and substitute it for the overall measure of taxes in the consumption function, we end up with the following expression, so that household consumption in total is going to depend on this exogenous consumption. It's going to depend also on the exogenous taxes that are paid, and then it's also going to depend on what's left over from income after we take out the endogenous component of taxes. We can illustrate this visually quite easily, and this is how we're going to proceed from here on, using a diagram with household consumption on the vertical axis and income on the horizontal axis. The consumption function will be illustrated in this framework with a positively sloped line. The height of that line on the vertical axis, the vertical intercept, will reflect the exogenous consumption as well as the exogenous taxation. And the slope of the consumption function will reflect both the marginal propensity to consume and the tax rate. And should either the marginal propensity to consume or the tax rate change, then the slope of the consumption function will also change. So we now are starting to get a very complete picture of planned aggregate expenditure. It has three very clear exogenous components, our planned injections, and here I've just added in some arbitrary numbers to give us some structure for this picture of planned aggregate expenditure that we're building up. So there's nothing special about those numbers. I've literally just made them up. Consumption, slightly more complicated than planned injections because it has both an endogenous and an exogenous component. Again, I've just made up some numbers here that don't seem unreasonable. Marginal propensity consumer 0.5 and a tax rate of 0.1 or 10%. And then I've just arbitrarily chosen some numbers for exogenous consumption and exogenous taxes. And then we also have an endogenous component, which I've written for you in the top right-hand part of that table. So what we have there is a complete representation of planned aggregate expenditure for a particular economy. I want you to note something. Whilst a great deal of planned aggregate expenditure is indeed exogenous, there is an important endogenous component, and that comes through consumption, and it comes through the fact that consumption varies systematically according to what is happening to income. So that planned aggregate expenditure, whilst a lot of it is exogenous in this framework, has a very important endogenous channel coming through income, in particular coming through the way that income in aggregate affects household consumption. And as an exercise, I'd like you to attempt to recreate this table. So what I've done in this table is on the first column, I've simply arbitrarily chosen various different flows of income, starting from 50 and going through to 150. In the second column, I've taken the information from the previous table and constructed measures of planned aggregate expenditure that correspond to each of these income flows. I'll remind you, the planned aggregate expenditure in total is consumption plus planned investment plus government expenditure plus export. So simply take that information from the previous table, combine it to get an expression for planned aggregate expenditure, and then substitute in the various different income flows and make sure that you are able to see what the corresponding planned aggregate expenditure is. Note the following. There is clearly a systematic relationship going on here between planned aggregate expenditure and income. The higher is income, the higher is planned aggregate expenditure. The third column is particularly important. It shows for each and every of these various income flows what the difference is between that flow of income. Now remember, income's GDP is the same as output. What the difference between that income flow is and planned aggregate expenditure. And I want you to note there is one and only one instance where there is no difference between the economy's aggregate income and its planned aggregate expenditure. Here we have satisfied our condition for macroeconomic equilibrium, and only there do we satisfy that condition. Everywhere else you would be looking at disequilibrium. I'll just write DIS for disequilibrium. It is only here that we have a particular income flow that has associated with it a flow of planned aggregate expenditure that gives us an exact match between that income flow and planned aggregate expenditure. What you're looking at there is the one unique instance for this particular economy that we are dealing with where we have the equilibrium condition being satisfied.